Hey everybody, it's Eric Green again from Green Sklarz. This podcast and this webinar, I'm doing both. I'm going to talk about filing those back tax returns. I've already discussed with you the idea of doing the state returns first. I hope you caught that one. Here's what I want to talk to you about. Thinking before you file, joint. A lot of accountants and a lot of taxpayers will simply default to filing joint returns. It can be a critical mistake. Okay, the key thing, as always, is when you have non-filers and you're going to get these people into compliance, you're prepping the returns, or if you're a taxpayer and you want to get the taxes, you want to sleep at night. You want to just resolve this, right? You watch those late night commercials and you don't know if it's true or not, but you want to resolve it. The first step is to get into tax compliance. You got to get all the returns filed that are due as of now. And you need to work on an arrangement. What I'm going to suggest to you is you need to do all of that before you file the returns. You got to go the next step and have your professional figure out how they're going to get this resolved. All right. Now, if you don't know me, again, I'm Eric Green. We are a boutique law firm, Green Sklarz. We have offices in Connecticut and New York, though we do federal tax cases all over the country. A little about me. The focus of my practice is civil and criminal tax representation. I've been doing this for 18 years. I am a former chair of the Connecticut Tax Bar. I am a former chair of a tax subcommittee for the American Bar Tax Section. I'm a fellow of the American College of Tax Counsel. I'm a columnist for the Journal of Tax Practice and Procedure. I am the author of the Accountant's Guide to IRS Collection. And for any of you accountants who took the CCH IRS certificate training for 20 hours, I was the guy lecturing on the videos. So I do a lot of this day in and day out. I teach this stuff for the AICPA, the NATP, the NAEA, and other national organizations, and we do this in our office every day. And so what I want to point out to you is we got it. So the client needs to get this resolved. The first thing is we got to get into tax compliance. So what's tax compliance? Tax compliance means we have filed all the returns that are due as of this moment, right? So I'm recording this now in August of 2017. The 2015 return and earlier returns should all be filed. 16 could be on extension right until October. For the IRS compliance, the last 6 years. All right, we've had people come in as long as 18 years without having filed a return. So to get into compliance, it's really the last 6 years that you need to do. They also have to be making their current tax payments. If you haven't seen this, this is Form CP 516. It's what the IRS sends out when they're trying to get taxpayers to file missing returns. Excuse me. What I wanted to talk to you about, though, the client comes in. If you're an accountant, the client comes in, you're right, you start prepping the returns, right? Federal returns, the state returns, are getting them all done. Or if you're a taxpayer and you go to your accountant, the general default is to file, if you're married, is to file married filing joint returns, right? Save money, keep the liability down. This can be a critical mistake. And this is why before you file that return, you need to go the next step and figure out how you're going to get this resolved. All right, and let me tell you why. We're going to file joint returns. There is something called joint liability. Both spouses now are equally responsible for what's on that return. And one of the things that irritates me is when accountants will tell me, oh, well, the spouse can always file for innocent spouse relief. Well, actually, no, she can't. Okay, I have one going. I have 2 cases now going in tax court on innocent spouse. We fight these cases. We do win these cases. They are not easy, and by the way, they are not cheap. All right, I think my client so far, one of them has spent $35,000, and it's still counting because we're in a real fight with the government over this. They do not give up joint liability easily. Okay, so we want to think before we file. Now, again, if you're not familiar with this, you can amend returns. So if you filed married filing separate, you can always amend to go joint. If you file joint returns, you cannot amend to go separate. You would have to go innocent spouse, which is, as I've already mentioned, an uphill battle. Okay. Now, why would you want to file married filing separate? Let's talk about an actual case, one that we actually had in our office. Husband and wife, she used to work in New York City, made a lot of money as an executive. Once they have kids, she now leaves work and is staying at home. She rolled her 401k over. She's got about $500,000 sitting in a 401k. She also inherited the house in Lower Fairfield County in Connecticut, Greenwich, Westport, very affluent areas. She inherits the home. It's worth more than $1 million, no mortgage on it. He has a pickup truck and a very small IRA. He is a self-employed salesman. All right, they had horrible things happen to them. Medical issues, emergencies, special needs child. They fall off the wagon and stop filing and paying for about 6 years. They go to an accountant. The accountant does the returns. The accountant is smart enough, as much as he annoyed me, he is smart enough to realize, look, before we file these returns, you need to go see a tax lawyer who's going to figure out what we're going to do. Sends me the returns. The clients come in. They're going to owe $625,000 married filing joint. So I go through the offer analysis, and I said, look, husband, you're a perfect offer candidate. You've got a car worth like $4,000 or $4,500 or something like that. You have $5,000 in an IRA. I can get rid of this for $3,500. But wife, you have $1 million home, no mortgage. You have a $500,000 IRA almost. All right, $500,000 IRA on the offer analysis, cash it in. You're going to get 70%, right? Because you got to pay your taxes and the early withdrawal penalty. So there's $350,000 right off the bat. Then you can get a mortgage on the house. You're going to end up full paying this. We're going to do married filing separate. I call the accountant while I'm there with the client, say, please send me the returns married filing separate. He does that, reruns he just goes in and clicks a button, spits out the returns, tells me, oh, Eric, now it's $800,000. We definitely want to do married filing joint. I said, no, we are doing married filing separate. And he said to me, you're going to cost them $175,000. He's saying the married filing joint will save them $175,000. I said, no, it's not. It's going to cost her $625,000. It doesn't matter what he owes. He can't pay it anyway. If we do married filing separate, and this, you have to understand this, she has not signed on to his tax liability. She's not responsible. Her assets will not come into play in the offer because she's not responsible. Right? Married filing separate returns. He now owes $800,000. It doesn't matter. He's not going to pay it anyway. All right. We go through the offer analysis. How's that? $4,000 in a vehicle. 80% quick sale value for an offer. $3,200. There's a $3,450 exemption for a vehicle. So there's no equity in the vehicle. Vehicle's off the table. The IRA. $5,000, 70% is $3,500. That's what we offered the IRS. That's ultimately what they accepted. $800,000 gone for $3,500. We saved her $1.5 million of assets. You need to think this through. Before you go and willy-nilly file joint returns, you need to sit down and do the extra step. Now look, if this hadn't been $625,000, but this had been married filing joint $50,000 versus $100,000, and they could just pay it, in other words, they weren't going to do an offer anyway, then clearly I would do the joint and save the money. But, although in this case, he could have still done it for $3,500 and still gotten rid of the $50,000 or $80,000 or $100,000. But there are cases where the married filing joint we would do because maybe they were both self-employed and they both owe taxes, so there is going to be no innocent spouse, or meaning they're both going to end up with liability, so they're going to end up paying it anyway. I mean, there are instances where this doesn't matter, but you need to go through that next step. You need to do the analysis, okay, to understand what you can and cannot do. All right? And remember, consider the tax resolution and rethink the idea of just married filing joint. I know it's a knee-jerk reaction from the accountants. We're going to do married filing joint because, stop. You need to think it through before those returns go in. And when clients come to see me, I will tell them, all right, give me your accountant's name, or we'll call them together. Or if you want to do it, you call them and say, prepare the returns. Do not file anything until my attorney has looked at them. And we get them, and meanwhile, we'll go through the analysis. And if we're better off, let's do married filing separate. If we're better off, let's file those state returns first. That was the other podcast I did. File the state returns first so we can get full credit for an installment agreement with the state to help us with our offer. All right, go check out that podcast if you haven't caught it. You got to think this thing through before you just go and file. So with that, I hope this has been enlightening for those of you who are starting in on the world of tax resolution. If you have any questions, clearly give me a call, 203-285-8545, or email me at egreen@gs-lawfirm.com. I'm Eric Green from Green Sklarz, and I hope you found this helpful. Thank you.